Our next guest warning a hiring slowdown is here. Let's welcome back Peter Boockvar. He's a chief investment officer at Bleakley Financial Group and also a CNBC contributor. Peter, great to have you with us. It feels like the markets want to see, slowing in the labor market. The markets want to see a reason to rally into year end. What derails that in terms of the print tomorrow?
Well, before today's rally, when I looked at the action early part of the week, I felt that maybe the market was shifting its attention from the happiness that the Fed's going to start cutting interest rates by stocks to starting to question, well, if they're cutting interest rates and oil prices are dropping, that means possibly a recession is upon us and maybe I should be selling stocks instead. So if you told me the number today, I don't necessarily know which one of those things that the market would sort of latch onto. I'm beginning to think, though, that if we see a weak print, I think the reality of a more dramatic economic slowdown next year is going to be more front of mind rather than, oh, the Fed's going to cut rates and everything is going to be fine. I think Dan's charts, was a good history lesson, and many people in the markets weren't around on trading desks during that, and that's because the markets focus more on the deteriorating economic situation rather than just the joy of the Fed cutting interest rates.
It's interesting, Peter. I think right now the market is pricing in 5 cuts next year, starting in March of next year, against a backdrop where I haven't really heard Jerome Powell waver all that much. So the market's seeing something that I don't think the Federal Reserve is necessarily seeing. So let's play it out a little bit. Let's say it's a strong jobs number tomorrow. Does that revert? I don't say it's reversing from 4.15 to 5% in the 10-year, but we have an auction coming up, a lot of things to be talking about. Could you see a significant move back up in yields on the back of a strong jobs number?
It is possible. I think, though, a strong jobs number based on a growing bunch of evidence that is pointing to a deteriorating pace of hiring, that I'm not sure if that one jobs number is going to really shake things on the upside. I do think what would be the most concerning thing is that after this fall in longer-term interest rates, if it reverses in the face of still weak data, that to me is a big flag, because we were 3 3/4 in July in the 10-year yield. So even with this pullback of about 90 basis points, we're still above where we were. And you can argue that the economic situation today looks weaker than it was in July. If you look at a lot of what retailers are saying and even a lot of the jobs data, whether it's continuing claims, whether it's what the PMIs have said, whether it's the job openings number, whether it's the hard to get question in consumer confidence, all are pointing to a slowdown in hiring. And ADP, the 3-month average in private sector hiring, according to ADP, is only 99,000. That's a clear slowdown from the pace we saw in the early part of the year and certainly versus last year.
So Peter, part of the reason why I think your work's so effective all the time is you have a macro view, you have an economist view, but you also have a view in terms of market positioning and sentiment, and you kind of weave that into an overall view. And the smart lady to my left yesterday talked about how the recession is now consensus. And there's nothing good about that in terms of positioning, in terms of what markets are doing, both in terms of possibly on the bond market, but that actually, no recession. I'm not sure if no recession is now consensus, not recession. Whereas we were in the consensus recession camp 1 year ago. Talk about positioning against that view.
Well, I think the one thing that caught people offsides that were in the recession camp, and I'm included in that for this year, was the belief that the sharp rise in interest rates would have a more broader, immediate impact on the economy. What I think we've learned is that it's more of a slow-moving train that's coming down the tracks, rather than affecting everybody at once. But the train is still coming down the tracks. I think we look at commercial real estate, for example. If your loan's not coming due until July 2024, well, you're okay up to this point. But that train is still coming towards you. So I think that is sort of what's made this tricky, is that the economic slowdown is, in what I see, is metastasizing. But just because it's slow doesn't mean it's not happening. But I think the slowness of it has gotten people complacent, thinking it's not going to happen.